Hey, what's up, everybody? This is Dave. This is a much different video than what I am used to bringing you, but I think that the markets are way overbought. I have thought they've been overbought for a number of years, and I'm going to talk about my thoughts on why I have been getting out of the market over the past 3 years, and more so specifically on Wednesday last week. I cashed out of everything, moved into cash, outside of two positions that I'll talk about in a minute. So stick around if you want to hear my thoughts on the market. All right, so a little bit about me. I spent a number of years trading foreign currency in the Forex market as a job, as a career. I was a day trader. I was researching currencies, euro against the US dollar, pound against the US dollar, things like that. I still trade for myself, but I don't do it as a career anymore. And so I have a lot of knowledge of market analysis, of risk to reward ratios, and of predictive analytics within pattern recognition in charts that look like the ones on the screen right now. So I want to walk you through this. This happens to be the Dow Jones Industrial Average, the DJI, which I have been tracking for since 2017. I started thinking and feeling that the market was overbought. It had just reached 20,000, and that was the highest it had ever been, and people were freaking out. And so you had some people that said, "Oh, it's going to the moon," and then you had other people like myself that said, "Well, we should be cautious because you always take the mantra of buy low and sell high." Well, if it's at the highest point it's ever been, why would you buy that? So like most people, I'm always looking for a deal. I want to buy at the lowest point and sell at the highest point and make as much profit as possible. So I started doing a little research back on this Dow Jones because I only had a currency background. I never did anything with stocks and never really understood the nature of stocks and how they acted. The currency market is a different beast. It's a 24-hour market. So the market candles only close on the weekends for about a day and a half, and then they open back up. And so it's just a much different environment. With this, what you're going to see here, this is a look back early Dow Jones. This is back in 1995. We had a push up. This is the most data that I can get from Yahoo Finance. So these charts are built in Yahoo Finance using their tools. It's not my preferred method, but they work as long as I can draw trend lines, horizontal lines, and some Fibonacci levels. I'm a happy guy. So here what we can see is the market pushed up. It took a little retracement, found a support point. It pushed up a little higher, came back down to that same support point, brought more significance to that support point, and then it pushed up a little higher. Now, if we draw the retracement from this bottom to this top, we can see that the market then retraced and dropped down and hit that 5-0 point. We have the typical, this light purple line here, 382 retracement, 5-0, which I've colored in black because of its significance, and then below that, the 618. Now, hindsight is always 2020, and we can easily go back and say, yes, that was the high point, and yes, I would have bought back in at the 5-0 point because it would have been stopped tanking, and I would have made a gob of money since then. Nobody ever trades well at the point in time. Everybody is always a hindsight trader, so we want to take a look at the market here in just a minute of its current position. But from that 5-0 point, it bounced off and it grew and grew and grew. And we had this lovely run up until 2008 when we hit another top point. I did not redraw any more fib levels because it came back down to not just the 5-0, but it also retraced and tapped the 618 of our earlier levels. Let's move into a year ago. This is from February 13th, 2019. And a year ago, the market had shot up past its 20,000 point, which is right here, and has gone parabolic in a straight up fashion, which always breeds confidence. That's sarcastic. Yeah, when it goes parabolic like that, and I'm freaking out going, okay, the higher and faster this goes up, the stronger and harder it's going to fall down. So what we look at, if we look back here, we can see back in this portion over here, this was our 2008, 2009. This was the initial run up here from 95 up to 2000. that we looked at. This was the retest of the 5.0. This was the 2009 drop right here, back down to that 618 level. Now, from that point, from the lowest point of 2009, we have seen straight up activity outside of a few minor retracements. So the market went up. It hit this top point here in 2015, retraced back, hit a support point, went up, retraced back, and now it's gone straight up since then. So why do I think that this market is overbought and needs to come down? Because it's overbought and needs to come down. So we can see this here, this 3-tap move or triple top or head and shoulders of some form is forming. And so what you see here is you have the first hit at 25,000. You have the second hit and then retraced and then comes back for a third time. And so this was a year ago. This is where the market was. February 13th, 2019. I drew a fib level from the bottom to the roughly the top here. And what I got was a 5.0 retracement back to these support points conveniently, which would be about 17,000 on the Dow. Now that would freak people out, but let's go forward. When we look at current day, we have fib levels still drawn from 2009. Now it's been adjusted to be at the very top where we just hit 30,000. You can see our 1, 2, and 3 tops right here in this pink line and how it has extended past. The other line that I've drawn more recently is this trend line of supports here and here. And so what are we looking at? What do I see in this chart? I see that the market has made this correction. It's hit its top point at 30,000. It has dropped off significantly, and it is first going to test this roughly 25,000 area again, where the support trend line is. If it breaks that, we have the 382 at roughly 21,000. We have a 5.0 still just above the initial 17,000 mark that I had before. And then we have the 618. Now, here's what scares me about the 618 is it pretty much lines up with these support points over here. You see that? That's a heck of a drop getting down there to the 618. And that is going to wreck some people because that's going to get down into the 16,000 area. When you go from 30,000 to 16,000, that is drastic. The other thing I'll point out, I watched the RSI. The RSI down here did re-hit at the 80 point and then has dropped off. Now, my feelings about this is that the market has been way exaggerated, way overbought, and needed a reason to come down. And in America, we could blame it on presidential stuff. We could blame it on just other stupid things that are going on, but they needed something bigger. The reason I changed my position last week is because of the coronavirus. The coronavirus has been initially it was confined within China, and then Adidas actually posted something about an 85% loss in their China region. Well, if Adidas is posting an 85% loss in just China, the day later, we had more reports outside of China of the coronavirus. My gut feeling was that this was going to be a tool used, however it was produced or created or whatever sparked the coronavirus. This was a tool that was going to be used to cause the markets to come down. And so if you can impact Adidas with a virus to lose 85%, you can then stretch that not just through Adidas, but multiple different categories of market, and you can take that across the world. And when you look at imports and exports coming in and out of China into all of the different countries of the world, you can see the downstream impacts and ramifications this could have on the markets. And so to me, I think personally, I decided to get out of everything. I cleared everything, every position I had in my 401k, any IRAs, any of that stuff that I manage. I moved it into cash. And then I have been cost averaging into two things, RYRAX and SQQQ. Now, this is not a promotion for you to go trade and make rash decisions. I'm not a financial analyst to make you any, all the jargon. I'm just a guy who's posting a YouTube video and has followed this for a bunch of years. So SQQQ opposes the market, and RYRAX also opposes the market. So I have been cost averaging into those for almost 12 months. So those are the only things I have left in my current investment policies for this reason right here. I'll get back in. I'll start averaging back in if I see it get down here to the 21,000 mark. Then I'll start averaging back in. When it gets down to the 17,000 mark, oh, I'm ready to buy everything for cheap. But anyway, that's my thoughts on the market. That's what I see the market doing. All right, so if you have thoughts on the market, I'd love to hear that in the comments. If you have thoughts on why I'm going to miss out on a bunch of money because I've moved to cash, I'd love to hear that. If you have thoughts on other stocks or investments that you have picked up in order to counteract this drop that we're seeing, let us all know. We'd love to hear your thoughts in the comments. That's it for this one. I hope I didn't freak you out too much, but we will catch you guys in the next video. Peace.